Something new that we're going to bring to our market commentary in 2024. Schneider Downs Wealth Management sits inside Schneider Downs and Company. We have almost 600 employees. We offer over 80 different service lines. My first colleague that we're going to have on is Tyler Reeder, who's a managing director in our corporate finance group. Spend 30 seconds telling everyone, for those of you that aren't familiar with Tyler, what your role is, and then we'll get into talking about the real estate markets.
Yeah, great. And Jason, thanks for having me here, and appreciate the opportunity to join everyone this morning. As Jason said, I'm a managing director with Schneider Downs Corporate Finance. We inside the kind of broader Schneider Downs umbrella, we run a real estate investment platform. We tend to focus on multifamily properties. We either buy or develop them, throughout the U.S. and use that and kind of to generate an investment product.
And Tyler has experience. Prior to joining us, he worked on the debt side of a very large financial institution that provided kind of all sorts of senior and junior debt to a lot of commercial real estate developers. And I think that's kind of where we want to start the conversation, which is commercial real estate is broad, and Tyler has an expertise here on multifamily, and we'll touch on that. But there's also office, industrial, life sciences, there's senior housing, there's hotels. But really, maybe let's just kind of focus on the broad macro market. What exactly changed in 2023 for commercial real estate writ large versus what maybe was the case in 2021 and 22?
Yeah, look, I think, changes in interest rates, certainly the elephant in the room. I would say, at your real estate, whether it's your home, an office building, an apartment building, it is generally financed with some amount of debt, and it is valuations and the cash flow that it generates is susceptible to the amount of debt that it has. And so as rates increase, that certainly has an impact and had an impact in 2023. I would say it impacted certain sectors and certain asset classes more than others. Multifamily has historically been more stable, and whereas you see, given changes in, work from home, folks being in the office, the office sector, I think has certainly made a lot of headlines in 2023, and we continue to think that will continue into 2024 and beyond as companies really figure out how much office space do I need, and sort of right sizing that. Ultimately, I think we're sitting here in our offices at One PPG in downtown Pittsburgh today. I'm a firm believer in companies are going to need office space for a long time. So I think that will continue to sort itself out. But certainly, office, I think, of all the asset classes, tended to get probably the most negative headlines in 2023. Driven, interest rates certainly have a factor in that. But as companies continue to think about, what's the need and the use for that over time.
There's this instinct, I think, among some in the financial press, right, to paint commercial real estate in like broad brushes, and I get it, because it's for as big as the equity market is, and for as big as the fixed income market is, real estate is just as big, if not bigger, right? If you took all the real estate in all the world and you added up the value, you're talking about it is up there, if not surpassing those markets on the debt and the stock side. And so I think that a universe that big is going to be very hard to paint with a broad brush. Obviously, interest rates, the interest rate sensitivity is going to be something that everybody has to deal with, whether you're a small cap stock that's got floating rate debt, or you take on commercial real estate where you've got floating rate debt, whether it's construction or through an acquisition. But maybe talk about some of the types of projects that are doing well, and some of the ones kind of from a macro level, like, hey, this is this is an example of something that's doing really well, and this is something that's maybe challenging. So I think give our audience a little bit of perspective on kind of not everything is as dire as Bloomberg or the Wall Street Journal may have you believe.
Yeah, look, I think the financial press, as you mentioned, Jason, it does tend to lump real estate as a whole, and I would, like any asset class, it's nuanced in difference depending upon, even within the same asset class of multifamily. An apartment building in Denver, Colorado performs and acts differently than something in Atlanta, Georgia. So I think real estate as a whole and as an investment and as an asset class is a longer term investment, right? It's not a stock that you can trade in and out of over a period of days or weeks. It tends to be longer term. And that while that period maybe has shortened in recently, still an average hold period, from a real estate property as an investment is somewhere between 4 to 7 years. And so that, if you line up sort of what makes an interesting or a stable transaction, certainly, long-term outlooks, fixed rate, long-term debt is a, hallmark of that structure. It allows for you to own a property, operate it through multiple market cycles, and you're not, concerned with the ability to refinance debt or fluctuations in interest rates over that 5 to 7 year period. We know they will change. We don't know how much they will change. That type of financing certainly, and that type of financing, a long-term view, tends to be, a good recipe for success, amongst other things. Where we see some challenges, certainly in the real estate space, is again, shorter-term outlooks, trying to sell properties in 18-month periods of time, using higher leverage, more amounts of short-term debt, and that short-term debt tends to be variable rate in nature, which can be hedged or managed, through to kind of help with those fluctuations. But in general, particularly in times of volatility, like we saw in starting in early 2022 and continuing through 2023, that can have a material impact in both the performance of properties, right, the amount of cash flow a property can generate, as well as the ultimate valuation of it. And as rates change, that certainly impacts what an investment property is worth as well.
So when we look at, and we always kind of, in our quarterly letter, we always use kind of publicly listed real estate, which is a decent proxy. I mean, it's, again, not to paint everything with a broad brush. And, we talked about just what happened in the fourth quarter and, small caps and mid caps just rallying. And, we use the Dow Jones US Select REIT Index as kind of a nice way to say, okay, what did publicly traded REITs do? And it was up a little bit over 16%. Pooled performance actually up for the year to up 14%, kind of finished off. And you do see that volatility. Maybe talk a little bit about why public REITs have a little bit more volatility to them than say something more like I don't see the volatility in my house, right, that I own. And it's obviously, these aren't residential, but just I don't see the volatility there. Maybe talk about why publicly traded REITs are so volatile.
Yeah, look, I think, owning real estate through a publicly traded REIT certainly has advantages such as, high levels of diversification. And I think what you're hitting on, Jason, too, is the liquidity of it, right? At any point, you are able to own real estate, get exposure to it, but you can trade in and out of it in a short period of time. That liquidity, the underlying assets of the REIT, though, are still long-term are still office buildings, apartment buildings, hotels, what have you, depending upon their focus. And so that certainly introduces some volatility for those publicly traded securities. As you've got, it's, yes, you can trade in and out, but it's ultimately the assets of the company and of the REIT are real estate underlying real estate properties. And so I think as you look at other ownership structures too for real estate, real estate tends to be valued when you can have it appraised and get values over time, but it's really valued when you buy it, and then it's valued again when you sell it. And regardless whether it's your single family home, an apartment building, real estate's worth, certainly what another buyer, is willing to pay for it. And that really drives pricing.
Obviously, I think that there's optimism about the level of the 10-year Treasury. Got as low as, I think, 3.78% kind of in the week, the days following Christmas, the Christmas holiday. Can you talk about what maybe the level of the 10-year Treasury means just in terms of like liquidity, right? Because we did not have a lot of that other than a select few transactions, some of which were beneficial for valuations because they sold at good levels. And in the case of a few people unloading some office properties they didn't want, it caused maybe a cap rate or a valuation to get out there that really wasn't indicative of the market.
Yeah, certainly. I mean, real interest rates in the 10-year have a huge impact on valuations for real estate properties. I mean, if you go back to, really June through October of 2023, just really a whipsaw moment in the Treasury market. I think 10-year Treasury was around 3.7 and increased right around 5% in that relatively short period of time. And that, from a valuation perspective, makes it very difficult for buyers and sellers of real estate to agree on a price. I think 2023 was the story, particularly in multifamily, of spread between what a seller was willing to accept or thought their property was worth versus what a new buyer also felt it was worth based upon their future cost of debt, which would be significantly higher than perhaps somebody who bought it several years ago. So I think that that led to certainly very low transaction volumes in 2023. We do expect that to come back a little bit in 2024, but I think it's still there's still, as valuations change over time, coming up with what's a true market value of a property, I think remains. There's still some disagreement amongst those that are buying and selling right now.
What we've read is that there is hope amongst, let's just say, the private equity community, the people that do the traditional buyouts of the HVAC companies or the car washes or your local mom and pop, the stores, that there's going to be more liquidity in 24 than there was in 23. It might not happen right away, but they do feel like it seems to be there's consensus in that segment that there's going to be a thawing at some point in 24. Yeah. Is that kind of what you're seeing in terms of transactions?
Yeah, certainly. I think an increase over what we saw in 2023. And I would say in general, look, real estate as an asset class, there has been a real estate investment market when interest rates were 10%, and there's certainly a real estate investment market when rates are lower. But and it works as an investment in both interest rate environments. Where the real estate market, where we struggle with valuations and where we struggle with that mismatch between buyers and sellers, is in times where generally when rates are increasing. Right. And the market has a difficult time understanding, is the ceiling 4%? Is it 5%? Is it 8%? Right. And the difference between those certainly has a big impact in valuations. And I think that was a big story and theme for 2023, is the Fed continued to increase, particularly in the first 3 quarters of the year, and signaled that they were going to continue to increase. That gave buyers a significant amount of pause because they're wondering, do we stop at 5 or do we stop at 7? Where we find ourselves today is with some more stability in that market, and that certainly helps increase transaction volume, gives buyers more confidence of where rates are headed.
Yeah, and I think we can kind of put a bow on this. Is like, if you would have fallen asleep on January 3rd of 2023, 10-year Treasuries right around 3.8%.
Yep.
You wake up on December 31st, 10-year Treasury yields at 3.8%. You're like, all right, guys, so nothing happened, and it couldn't have been further from the case.
Yeah.
And so I think that's an interesting way to just kind of show that in the real estate market, one, it's not a monolith. I think that's a myth, and that's why it's good to have someone on the team, a resource that we can talk to about not only the publicly listed market, but in the debt market too, because a lot of the transactions priced off of the 10-year Treasury yield and level, and certainly publicly listed real estate was in the have-not category for the first 10 months and 14-ish days of the year, and then it quickly became a have. And so I think we'll probably have you on later in the year to kind of, let's just maybe 6 to 8 months, 6 to 8 months from now, because I do think it'll be interesting to see, is there follow through in the private markets to what happened in the public markets, or was this maybe a case of getting a little bit too far ahead of ourselves? So there's no shortage of things to talk about. This is a new segment. We're really excited to showcase to our clients of the firm, but also our friends of the firm, other colleagues that we have access to that help inform a lot of our investment decisions here at Schneider Wealth Management. So Tyler, until then, thank you very much.
Jason, great to be with you.
Appreciate it.
Thank you.
Take
much.
care.